The finance calculator on the dealership website asks you one question: what monthly payment works for you? Not what can you afford, what works for you. You type in $900 because that sounds manageable, and it spits back a car, a real one, fully loaded. The math checks out, at least the math they're showing you. Here's the math they're not showing you. As of the start of 2026, the average new car in America costs a little over $50,000. The average monthly payment on a new vehicle just hit a record $770. And auto loan delinquencies, the share of people who fall at least 90 days behind on that payment, just climbed past 5.6%, officially the highest rate ever recorded, higher than the peak of the 2008 financial crisis. Not close to it. Past it. So the actual question isn't whether $900 a month works for you today. It's why, at the exact moment car prices hit an all-time high, more Americans than ever, including during the worst recession in modern history, are falling behind on paying for them. Something in that math doesn't add up, and by the end of this, you're going to know exactly what it is and exactly what income you'd actually need to buy a $50,000 car without quietly becoming part of that 5.6%. Let's start with the honest framework. The one lenders won't volunteer. Because it's not designed to sell cars, it's designed to protect you from buying one you can't actually afford. It's called the 24-10 rule, and it has three parts: 20% down, a loan term of 4 years or less, and a total transportation costs, meaning the payment plus insurance plus fuel plus maintenance, capped at 10% of your gross monthly income. Now let's run an actual $50,000 car through that rule, honestly. With today's numbers, 20% down on $50,000 is $10,000 in cash before you've paid a single tax or fee. That leaves $40,000 financed. At today's average new car rate, right around 7% for a well-qualified buyer. Financed over the recommended 48 months instead of the 72, most dealerships will quietly steer you toward your payment comes out to approximately $958 a month. For that payment alone, to sit at 10% of your gross monthly income, the rule requires an income near $115,000 a year. And that's before insurance, which on a $50,000 vehicle typically runs somewhere between $150 and $250 a month, depending on your state and driving record. Before fuel. Before the maintenance reserve, every honest financial advisor tells you to set aside, once you fold in the full picture of ownership, not just the loan payment, you're realistically looking at total monthly transportation costs in the range of $1,300 to $1,500. To keep that at 10% of gross income, the honest number isn't $115,000. It's closer to $140,000 to $160,000 a year, depending on where you live and what insurance costs in your state. The median household income in the United States right now is roughly $80,000, not the median individual income. The median household meaning frequently two incomes combined, which means using the actual rule financial planners have relied on for decades. The median American household isn't just short of affording the average new car. They're short by a wide, almost uncomfortable margin. And that gap is exactly why the average loan term has quietly stretched to 69 and a half months instead of 48. It's not that people are choosing longer loans for flexibility. It's that a 48-month loan on the average new car is mathematically out of reach for most of the country. So lenders extend the term until the monthly number looks survivable, even though the total cost of the car goes up substantially every additional year you stretch it. Here's where this gets genuinely dangerous instead of just uncomfortable. Stretching a loan from 48 months to 72 months doesn't just cost you more in interest, though it does. Typically several $1,000s more on a loan this size. It creates something called being underwater, where you owe more on the car than it's actually worth. For a much longer stretch of the loan, cars lose roughly 20% of their value in the first year alone. On a longer loan, your balance falls slower than the car's value does, which means for 2, sometimes 3 years, if that car gets totaled, or if you need to sell it, or if you simply need to trade it in for something more practical, you're writing a check to make up the difference on a car you no longer even own. This is precisely the mechanism behind the record delinquency numbers. It's not that people can't make one payment, it's that they're trapped in a loan on an asset worth less than what they owe, with no way out that doesn't cost them money they don't have. Let's talk about the actual math of what a car that expensive costs you beyond the loan itself, because this is the part that connects directly to everything else we've talked about on this channel. That $958 monthly payment, if instead it had gone into an index fund earning the market's long-term historical average, would be worth roughly $72,000 after just 4 years of contributions, assuming an 8% return, purely from the payments themselves before any additional growth. Stretch that same monthly amount out as an ongoing habit for 15 years, replacing a car payment with an investment, and you're looking at a figure north of $300,000. The car depreciates the entire time. The alternative compounds the entire time. Same monthly number, completely opposite trajectory. Now, to be fair to the people genuinely earning enough to make this work, because plenty of households legitimately clear $150,000 a year and can absorb this without strain, the problem was never that $50,000 cars exist. The problem is the gap between what the dealership shows you, a monthly number that can be engineered to look affordable at almost any income through a long enough loan term, and what the actual math says that your income needs to be for that number to be sustainable rather than fragile. A payment that fits your budget on paper and a payment that survives a job loss, a rate hike, or a bad year are two very different things. And the record delinquency numbers we're currently sitting at suggests a lot of people found out the difference the hard way. The honest version of this conversation isn't never buy a nice car. It's know your actual number before you sit across from someone whose entire job is finding a monthly payment you'll say yes to. If your income doesn't clear roughly $140,000 a year, the math says a $50,000 car isn't a stretch. It's a structural risk, regardless of what number the calculator shows you. And if it does clear that number, the real question isn't whether you can afford the payment. It's whether you've actually compared what that payment builds if it goes into the car, against what it builds if it goes almost anywhere else. Subscribe if you want the next video where we run this exact math for used cars, leasing, and the actual break-even point where financing stops being the worst option and starts making genuine sense.